Let us run a stock health checkup on Microsoft, ticker MSFT, currently trading at $374.35. Looking at its yearly range from a low of $356 to a high of $555, Microsoft is trading incredibly close to its yearly low bargain bin, sitting at just 9% of its annual range. Let us look at the price tag of this business. The price, compared to its past profits, is 22 times, which is the storefront price tag we pay for its current earnings. But that price tag drops to 19 times next year, meaning it is expected to get cheaper over time. This premium is completely justified because Microsoft is an exceptionally efficient cash generation engine, converting over 39% of every dollar of sales directly into pure take-home profit. Looking inside their corporate savings vault, they hold a massive $78.2 billion in cash. While they do carry $125.4 billion in total debt, their massive cash cushion and steady roller coaster speed mean there's very little financial stress. Our final retail audit verdict is that Microsoft is a financial fortress, combining world-class safety with a highly efficient cash machine that is currently on a premium discount. Microsoft is locking into a defensive holding pattern as of June 24, 2026. Trading at $374.35, the stock is currently stuck in a structural bear market. The core culprit is the 200-day moving average, the stock's ultimate long-term line in the sand, which sits far above at $447.64. With the 50-day average trapped underneath it, the big picture remains heavily weighed down by seller pressure. However, for short-term traders, there is a silver lining inside the volatility corridor. The Bollinger Bands, essentially a normal price highway with a ceiling at $459.48 and a floor at $353.01, show that Microsoft is trading smoothly right down the middle of its historical track. While the long-term trend demands defensive caution, the immediate volatility remains highly stable. Look at Microsoft's momentum speedometer. On June 24th, the stock is holding steady at $374.35, with its relative strength index registering at 35.6. Think of the RSI as a stock's internal pressure gauge on a scale from 0 to 100. Anything over 70 means the asset is overheating on pure hype, while anything under 30 indicates heavy panic selling. Sitting at 35.6, Microsoft is resting in a healthy, neutral zone. The aggressive selling pressure we saw earlier has finally tapped the brakes. This is a highly balanced tug-of-war, where the stock is cooling off without collapsing, giving retail investors a clean, stabilized window to watch. Microsoft is showing a clear shift in momentum as sellers take the wheel. On June 24, 2026, the technical speedometer is flashing a bearish cooldown, with the trend gap stretching to minus 4.4. Think of this momentum indicator as a car's engine speed. Right now, the immediate acceleration has run out of fuel, putting the directional speed in favor of the sellers. However, there is no sign of panic. Trading volume is holding at a steady 12 million shares, confirming a normal rotation where large institutional funds are simply adjusting their portfolios. The brakes are being applied, but the market is moving in an orderly fashion. Microsoft is climbing an accelerating staircase of pure profitability, with quarterly net earnings velocity expanding at a blistering 23.1% year-over-year pace. Looking at the bottom line, the trailing 12 months locked in $16.79 of pure gold in the corporate vault for every single share. Right now, the current year estimate steps up even higher, establishing a rock-solid platform at $16.84. But the real story is the forward-looking horizon, where expectations leap to an impressive $19.35 per share. This is not just incremental progress. This is a high-velocity cash machine consistently scaling up its profitability staircase, leaving no doubt about the immense momentum driving this tech giant upward. Microsoft is proving that you can pay a premium price and still get a structural bargain if the corporate engine grows fast enough. Look at the valuation compression. While the trailing price-to-earnings ratio sits at 22.29, the forward price-to-earnings drops to 19.35. This critical drop means Microsoft is rapidly growing into its valuation, transforming today's premium into tomorrow's discount. With a PEG ratio of just 1.13, the price you pay is almost perfectly matched to its earnings expansion. Yes, an enterprise value to revenue multiple of 8.88 and a price to book of 6.71 demand a premium. But with an enterprise value to EBITDA of 15.31, the pure, unadulterated gold left behind in the corporate vault easily justifies this entry point. This is not a dangerous valuation trap. It is a premier asset compounding at a very reasonable premium. Look at the absolute scale of Microsoft's financial machine. In June 2025, the massive pool of raw cash flooding through the corporate front door sat at over $76.4 billion. Fast forward to March 2026, and that quarterly revenue pipeline has accelerated to nearly $82.9 billion. But the real story is how much of this translates to profit. Microsoft's net income, the pure, unadulterated gold left behind inside the corporate vault after everyone else gets paid, surged from $27.2 billion to a spectacular peak of $38.5 billion in December, before stabilizing at an impressive $31.8 billion in the spring of 2026. This trajectory demonstrates immense monetization power, making it incredibly clear why the market continues to treat this tech giant as an absolute fortress. Look at the sheer structural scale of Microsoft's financial fortress. In June 2025, the tech giant generated a massive $25.5 billion of free cash flow, the pure, unadulterated gold left behind inside the corporate vault. Even with a seasonal drop to $5.8 billion in December, the company quickly accelerated back to $15.8 billion by March 2026. But the real institutional story lies in how they manage their leverage. While generating this massive pool of cash, Microsoft consistently chipped away at its outstanding liabilities, driving total debt down from $60.5 billion in June 2025 to $56.9 billion by March 2026. This is the hallmark of an elite compounder, shrinking its debt burden while flooding its vault with billions of dollars in fresh cash. Microsoft is demonstrating incredible operational scale for the period ending March 31st, 2026. A massive pool of raw cash flooding through the corporate front door reached $82.89 billion. From this haul, $26.83 billion was surrendered to the mandatory manufacturing toll booth to build and deliver its products, preserving a massive gross profit of $56.06 billion. Next, the corporate rent, elite engineering salaries, and heavy development costs, keeping the lights on in the labs, took $17.66 billion in operating expenses. That leaves an operating income of $38.40 billion. Finally, after taxes and interest took another $6.62 billion, we find the pure, unadulterated gold left behind inside the corporate vault. $31.78 billion of net income, converting over 38% of all incoming revenue straight into absolute profit. Microsoft is executing at an institutional scale that demands immediate attention. In fiscal year 2022, the massive pool of raw cash flooding through the corporate front door was already a massive $198.27 billion. By fiscal year 2025, this annual top line surged to an astronomical $281.72 billion, representing a 12.4% compound annual growth rate. Even more impressive is the operational efficiency. Operating income rose from $83.38 billion to $128.53 billion, proving that their enterprise engine is scaling with massive operating leverage. Finally, look at the pure, unadulterated gold left behind inside the corporate vault after everyone else gets paid. Microsoft's net income exploded from $72.74 billion in 2022 to an incredible $101.83 billion by 2025. This is institutional dominance weaponized to print pure bottom-line value. Look closely at Microsoft's financial engine, where a massive divergence has just triggered a major forensic audit warning. While the standard price-to-earnings multiple sits at an attractive 22.3 times, the hard cash multiple of enterprise value to free cash flow tells a completely different story at a staggering 76.3 times. This massive 54.03 spread discrepancy indicates that paper profits look artificially boosted compared to the actual raw cash velocity flowing into the corporate vault. Yet, despite this accounting accrual distortion, Wall Street's institutional consensus remains a resounding strong buy. 55 analysts are looking past the paper variance, projecting a massive runway from the current $374 price tag up to a mean target of $561, with the most bullish targets screaming towards $870. The street is betting on future scale, but smart money is watching the cash flow discrepancy very closely. Quick heads up before we wrap, this video is entirely for educational purposes and should not be taken as professional financial advice. Always do your own research before investing. If you found this breakdown helpful, hit that like button, subscribe to the channel, and share this video with your friends to help them stay ahead of the next big market move. Have a specific stock you want me to audit next? Drop the ticker symbol down in the comments and I'll take a look.